Fellow investors, this video, we're going to be looking at a stock that was once popular, had a massive run during COVID, and is not quite hitting the mark anymore, and that is Domino's Pizza here in Australia. Peaked at $160 per share, and it bottomed out at about 13 bucks per share this year. Seen massive change. We've seen the CEO, Dom Madge, resign, step away, and he was credited with a lot of the innovation and a lot of the growth in the stock. Always been interesting. I made some money on it, trading it during COVID. But the product has always been a little subpar. Personally, I'd probably prefer almost any other pizza. So I think that's maybe reflected in the stock price, but it's starting to get a bit of interest now from the top end of town. A lot of the money managers are thinking that perhaps it's grossly undervalued and they've got some upside happening as well. So this video, we're going to be applying our methodology of looking at the numbers as well as that human emotion side and looking at the price to earnings ratio to really guide us on what investors are willing to pay once this company is up and running and making some money. So just a disclaimer, going to put up there quickly, everyone for you to read, just saying this is not financial advice. I'm just really here to more or less entertain you and just give you a bit of education as to how stocks are valued and how you can go through and calculate what they might be worth. Whether you invest or not, up to you, and you should probably get some financial advice. So let's go through our methodology, and we know the first thing that we are looking for is what our price to earnings ratio history is, because that gives us a really good idea as to what people are willing to pay for it. So on Simply Wall Street here, I'm going to have a lot of information, a lot of different analysis. This is interesting based on a discounted cash flow, saying that it's 27% undervalued. So that's coming at $25 per share. It's quite interesting. But what we want to do is have a look at their price to earnings ratio. And funnily enough, this is where it generally sits. But I'm assuming that it's not making any money at the moment. And that's why they've gone to the price to sales. Let's go to price to earnings and having a look over the last 5 years where they've got the data. And as you can see now, yeah, it's coming in at zero. So that means that they're losing money. But I'd imagine there's going to be forecast for that to gain money in the future. And we can have a look here. It's actually stayed pretty steady over kind of the last 5 years. We've got 46. Actually, that's kind of misleading. Went up to 71. These are crazy numbers for a takeaway business. 95. I'm going to ignore the upper end 570 because I think what happened there was they'd have made very, very minimal earnings, but the share price was already reflective in that. So I'm going to ignore that and come back to probably looking more in this area is going to give us a bit more of that concrete data. So we've got a range of 46, 43 is the lowest, 35, 28 to 95. All right, 28 to 95 times earnings. It's going to be really interesting. So we're going to go up and have a look at our sheet. So the lower PE is looking at 28. Higher PE, I think I was about 70. Again, these numbers are insane. No wonder that stock crashed. And then what we want to do is find the average. So we can see pretty simply 70 plus 28 is 98. And then we halve that. So we're looking roughly, well, not roughly, but we're getting 49 as the average. Not 549, that would be crazy. Average PE of 49. So again, that's the average price investors are willing to pay for the earnings on this company. So quite high for this type of company, but investors have been willing to pay that in the past. So it'll be interesting to see what comes up with in terms of the earning per share. And that's the next part that we're going to calculate. So heading back over to our Simply Wall Street page and seeing what the analysts come up with for their earnings per share. Future growth. Okay. It's a bit interesting. So at the moment we've just crashed. So the earnings per share is minus, which is always a good indicator. So we're going to go forward to, we've got the end of June 2026, and we've got 11 analysts coming in somewhere between $1.10 and $1.38, with the average being $1.24. So $1.24 earnings per share is really interesting, given that's going to be the highest it's been for a while. And then they think it's forecasting out to $1.67. And again, the closer in time we do this, the more accurate it is. So we're going to go and put $1.24 up there as that average earnings per share. So now what we want to do is come up with a price range of the higher end and the lower end. And we do that through multiplying the lowest price to earnings ratio by the earnings per share. So if we do that calculation now, the lowest earnings price to earnings ratio is 28. Multiply that by $1.24. So $34.72 is what we're looking at, the lower price. 34.72. Got to whack that in here. And then the higher end, same formula again, which will be really, really interesting. Given that we've got 70 as that higher piece, but for the simplicity, we'll go through and do that. So it's going to be 70 multiplied by 1.24. And we're coming up with 80. Let's round that up to $87. So that gives us a really broad price range. And then that middle ground, or that average, again, using that average number, 49 by $1.24. 49 multiplied by $1.24. And we come up with, again, round up $61 per share. So this is going to give us some really interesting info, ranging somewhere between $34 and $87 over the next 12 months. But if you remember back to when I started this video, we seen what the share price actually was. And it's $19 per share at the moment. So given that our lowest point, based on what investors are willing to pay for earnings, remember our lower end was $34.72. So getting close to double, with that midsection being 61. Now, I think this is a little bit unique in that it hasn't been stable in terms of the earnings, and it's had some big fluctuations. So this calculation really works when the earnings are more steady, more predictable, and they've actually made earnings or made money over a recent period of time. But really interesting for what we're seeing, particularly if the analysts are right. And historically, even if investors are willing to pay 30 times earnings and they miss the mark and they make $1 per share, then you're getting $30 and plenty of upside in that as well. So it'd be interesting to apply the methodology and see what the upper end was. So it peaked at $36 for the year, and then the low point, 13. So 36 and 13 is what it's been trading between. 36 was kind of the lower end here rather than 13. So, yeah, very interesting applying it to this stock. But, yeah, still confident given that that sort of period of time, and then it has reached that high previously of around that $36 mark. So I think once it starts making money, and as forecast to do that within the next 12 months, I think it'd be very interesting in terms of what investors are going to be doing. It says CEO Don Beige is there, but I swear he stepped away. So yeah, that's the analysis. So looking at the potential upside downside of this, if it is making earnings, and then investors are willing to pay that $30 per share earnings, and potential upside of $30, which for this is about a 50% gain within a 12-month period, which would be really interesting. But again, this one, very different. A lot of media attention, a lot of focus, a lot of things outside the numbers. And we've just come off a period, where it was really, really grew during COVID. Everyone did lockdown, ordering pizza. I think that had a lot to do with it. But certainly worth watching in my books, particularly if the big end of town starting to get interested and starting to look to allocate their money. So that's the calculations. Domino's Pizza going to be doing more and more of these videos. If people like them, I'll keep doing more. And comment below if you want me to cover a stock. Again, it's a lot easier with the bigger kind of companies. I know there'd be temptation to go into the small caps and the mid cap stocks. This methodology is a little bit harder if they don't have, solid earnings over a period of time, and they're not as popular, and the price to earnings is all over the place. We've seen, even something the size of Domino's Pizza a little challenging. So try and aim for some of those big companies. Put them in the comments. Ask any questions. And in the coming weeks, I'll put together a program as well that teaches you how to do this yourself. It's going to go step by step. On how to analyze it and where to get all the information for free. So, as you've probably seen, I'm using some paid subscriptions. It's probably costing $300 per year, but I'll go through and do a program that shows you how to do that for free, and you can go through and analyze as many stocks as you want.